Welcome to the deep dive. Today we're taking a closer look, really getting into technical analysis in financial markets.
Yeah, we're talking stocks, bonds, indexes, commodities, futures, basically anything you can chart.
And the mission here is to understand how these technical analysts work, how they use historical data, price and volume.
To try and figure out where prices might head next. It's fascinating, really.
It is the core idea, well, it's that history tends to repeat itself, or at least rhyme, as they say.
Right, human behavior in markets, when faced with similar situations, often produces similar patterns. It's about recognizing those.
And charting is the main tool for that, isn't it? Making those patterns visible.
Absolutely, it's all about visualizing that price and volume story over time.
Okay, so let's unpack this a bit.
What's really key is how central these charts are. Line charts, bar charts, they help analysts spot those repeating behaviors.
By plotting price against time. It could be a simple line just connecting the closing prices each day or week or whatever.
Or bar charts, which give you more info, the high, low, open, close for the period. Much more detail there.
And it's not just for day traders, right? This applies to longer time frames too.
Oh, definitely. You can look at quarterly charts for the big picture, or zoom right into hourly data if you need that short-term view. The principles are kind of the same.
But I guess the patterns are clearer over longer periods. Less noise.
That's generally the case, yes. Longer time frames tend to smooth things out, make the underlying trends a bit easier to see. Shorter ones can be, well, choppy.
So technical analysts are really focused on the interplay of supply and demand, as shown in the price and volume.
Exactly. They're less concerned with why people are buying or selling the news, the fundamentals, and more focused on what the market is actually doing, the price action itself.
Looking at the what to anticipate the where makes sense.
So let's get into those chart basics. Vertical axis is price, horizontal is time. Pretty standard.
And we mentioned line charts, bar charts. Point and figure is another type, though maybe less common these days.
True. But the key concepts you start seeing are things like support and resistance.
Ah, yes, support. That's like a price level where, historically, buying interest seems strong enough to stop the price falling further. A floor.
Precisely. Buyers tend to step in around that level. And resistance is the opposite, a ceiling.
Where sellers tend to emerge and prevent the price from going much higher.
Yeah, these aren't exact lines, more like zones, places where the market has reacted before.
And then you connect these points, right?
Yep.
Trend lines.
Exactly. You draw a line connecting a series of, say, rising lows in an uptrend.
Or falling highs in a downtrend.
Mm-hmm.
Helps visualize the general direction.
Right. Defines the trend. And you can even draw a parallel line to create a trend channel.
Showing the range the price has been bouncing within.
Okay.
So what happens when the price breaks out of that channel? Or maybe through a key support or resistance level?
That's a breakout, yeah. And analysts watch those closely.
Very closely. A break above resistance might be a buy signal. A break below support could be a sell signal, potentially. And volume is crucial here, isn't it?
Oh, absolutely crucial. A breakout on, really high volume carries much more weight. It suggests strong conviction behind the move.
Like the market is shouting, "We mean it!"
Sort of, yeah. Low-volume breakouts are much more suspect. Could be a fake-out.
And before these big moves, you often get that sideways action, the trading range.
Yeah, where the price just bounces between support and resistance for a while. Consolidation.
Okay, so moving beyond the basics, let's talk patterns, reversals first, when the trend might be changing.
Right. The classic one everyone talks about is head and shoulders.
Yeah.
A top reversal pattern.
Okay, explain that, like a silhouette.
Kind of. You get a rally to a peak, the left shoulder, then a dip, then a rally to an even higher peak, the head.
Then another dip, then a final rally to about the same height as the first peak, the right verter,
And
then a decline.
exactly. And you draw a neckline connecting the low points of those dips.
And if the price breaks below that neckline, especially on high volume,
that's considered the confirmation. Suggests the uptrend is over and a downtrend might be starting.
and there's an inverse version for bottoms.
Yep. Inverse head and shoulders. Looks flipped upside down. Signals a potential end to a downtrend.
What about simpler reversals, like double tops or bottoms?
Yeah, much simpler visually. A double bottom is when the price drops to a level, rallies, then drops back to that same level again, finding support.
And then rallies decisively. Suggests that support level is pretty strong.
Exactly. And a double top is the mirror image at a resistance level. 2 failed attempts to break higher.
Got it. Are there quicker reversals, like within a single day?
Sure, you can have a one-day reversal. Price moves strongly one way, then snaps back and closes near the other end of its daily range.
And key reversal days, Similar idea.
Very similar. A key reversal day makes a new high in an uptrend or new low in a downtrend, but then closes sharply in the opposite direction. The bigger the price range that day, the more significant it potentially is.
Interesting. What about those island reversals you mentioned?
Ah, yeah, those are pretty dramatic looking. You see a price gap, then some trading happens for a few days, maybe.
And then another gap opens in the opposite direction,
Yeah.
leaving that block of trading stranded, like an island.
Exactly. Often signals a pretty abrupt shift in sentiment.
Okay, so those were reversals. What about patterns suggesting the trend will just continue after a pause?
Right, continuation patterns, like pennants and flags.
Pennants. Like little pointy flags on a flagpole.
Kinda, yeah. You get a sharp move up or down, the flagpole, then a short period of consolidation where the price range narrows, forming a small triangle or pennant. Volume usually dries up during the pennant formation.
And then the price breaks out in the original direction.
That's the expectation, often on increased volume again. Flags are similar, but the consolidation looks more like a small sloping channel against the main trend.
Like a flag fluttering downwards in an uptrend before it resumes.
Precisely. And triangles are common too, symmetrical ones where highs get lower and lows get higher, converging.
Or descending triangles, with a flat bottom, support, and lower highs pressing down on it. Usually resolve in the direction of the prior trend.
Typically, yes. And volume tends to decrease as the triangle forms, then picks up on the breakout.
We also mentioned rounding tops and bottoms. More gradual.
Much more gradual, a slow curve, suggesting a loss of momentum and a smoother transition between trends rather than a sharp reversal.
Okay, let's shift gears slightly. Gaps. Those empty spaces on the chart. What causes them?
Usually an imbalance between buyers and sellers overnight or over a weekend. Maybe some big news comes out.
So the price opens significantly higher or lower than where it closed previously.
Right. And there are different types. Breakaway gaps happen right at the start of a new move, breaking out of a range.
Continuation gaps or runaway gaps occur mid-trend.
Yeah, suggesting the trend is still strong. And then exhaustion gaps can sometimes appear near the end of a trend, signaling it might be running out of steam.
Do gaps always get filled or closed? Does the price always go back?
People talk about that a lot, but there's no rule. Sometimes they do, sometimes they don't. And even if they do, it could take days, weeks, or even years. It's not a reliable timing tool on its own.
Good caution. And we need to be careful about false signals too, right? Traps.
Definitely. Bull traps and bear traps?
So a bull trap is when the price pops above resistance, looks like a breakout,
Sucks in buyers who think it's going higher.
but then it quickly fails and drops back down below the resistance level. Ouch.
Yeah, leaves those buyers trapped. And a bear trap is the opposite below support. Looks like a breakdown, sellers jump in.
And boom, it reverses and rallies, trapping the shorts,
Leads to what some call trader's remorse. It happens. Need to look for confirmation.
which brings us back to volume. We said it's crucial for confirmation.
Absolutely fundamental. Price tells you what happened. Volume gives you a clue about how much conviction was behind it.
So, simple rules. Price up, volume up, bullish.
Generally, yes. Confirms the buying interest. Price down, volume up bearish.
Yeah.
Confirms selling pressure.
What about price up, volume down?
That's a potential warning sign for an uptrend. Suggests enthusiasm is fading. Maybe the rally is losing steam. Bearish divergence.
And price down, volume down.
That can actually be bullish sometimes. Suggests sellers are losing interest. Maybe the downtrend is exhausting itself.
Okay. And you mentioned accumulation and distribution.
Right. Accumulation is subtle buying, often happening during sideways or slightly down periods. Smart money, perhaps, building positions.
How would you spot that with volume?
You might see volume stay constant or even pick up a bit on down days within a range, suggesting buyers are absorbing the selling without pushing the price up yet.
And distribution is the opposite, selling into strength.
Yeah, maybe you see big volume on days where the price tries to rally but can't make much progress, or heavy selling volume as the price starts to roll over.
There's an indicator for this, right? Accumulation distribution line.
Yep, it tries to quantify it by looking at where the price closes within its daily range, weighted by volume,
Yeah.
tracks the flow.
What about selling climaxes?
That's a dramatic event. Often after a long decline, you get a day or two of huge volume, panic selling, but the price doesn't fall much further, maybe even closes higher.
Suggests the selling is exhausted and strong hands are buying.
That's the interpretation, yeah. Potential bottom. Churning is kind of the opposite feel. At the top of a long rally, you get high volume, but the price barely inches up, like wheels spinning in mud. can be bearish.
And on balance volume, OBV?
OBV is a cumulative indicator, adds volume on up days, subtracts it on down days. You look for whether the OBV line is confirming the price trend or diverging from it.
Divergence being the key warning signal again.
Often, yes. And there's the upside-downside volume ratio, too, simply compares total volume in rising stocks versus falling stocks. Gives a sense of broad market pressure.
Okay, let's broaden out from volume in single stocks to market breadth. How widespread is a market move?
Exactly. Is the whole army advancing or just a few generals? Breadth indicators help answer that.
The main one being the advanced decline line, or AD line.
Yeah, probably the most well-known. It's a cumulative total. Add the number of advancing stocks each day. Subtract the declining ones.
So if the market index is rising, you want to see the AD line rising too, confirming broad participation.
Ideally, yes. If the index is making new highs but the AD line is lagging or falling, that's a negative divergence, a warning sign. Fewer stocks are carrying the market up.
Suggests underlying weakness.
It can, yeah. It's often seen as a leading indicator at tops, and positive divergence can happen at bottoms.
Are there other breadth measures?
Oh, plenty. There's the Zweig breadth thrust indicator, McClellan oscillator, McClellan summation index. They all look at advancing versus declining issues in different ways, often using moving averages or differences.
Trying to gauge momentum or turning points based on the internal strength.
Pretty much. And then there's the arms index, or TE.
That one's a bit different, involves volume too.
Right. It's a ratio of ratios. Compares the ratio of advancing to declining stocks with the ratio of up volume to down volume.
So a reading below 1.0 is generally bullish, suggesting more volume is behind the advances.
That's the general idea, yes.
Yeah.
And above 1.0 is considered bearish. Though, like all indicators, its short-term forecasting value is debated.
What about just looking at new highs and new lows?
Simple but effective. In a healthy uptrend, you want to see a good number of stocks hitting new 52-week highs. If that number starts shrinking or the number of new lows starts expanding, it's another breadth warning.
You can look at the ratio or moving averages of these numbers too.
Yep. All ways to gauge the underlying health of the market trend.
This naturally leads into sentiment, right? The mood of the market. And this idea of contrary opinion.
Exactly. The core concept of contrarianism is that the crowd, the majority of investors, tends to be most bullish right at market tops and most bearish right at market bottoms.
So you try to gauge that sentiment and potentially do the opposite.
That's the theory. Find indicators that measure extreme optimism or pessimism.
Like looking at what investment advisors are saying. Advisory service sentiment.
Right. Data providers track this. If, say, 60% or more advisors are bullish, some contrarians see that as a sell signal. Too much optimism, maybe everyone who's going to buy has bought.
Interesting. It's a lagging indicator then, in a way.
Often considered so, yes. Extreme readings suggest the move might be getting crowded.
What about short selling? How does that play into sentiment?
Several ways. You can look at the amount of short selling by different groups. The public short ratio, for example, how much stock individuals are shorting.
And high public shorting is seen as bullish. Contrarian view again.
Often, yes. The idea is that the public is often wrong, plus all those shorts represent future buying demand when they cover their positions. Specialist short ratios are watched too, sometimes seen as smarter money.
And the overall short interest ratio. Total shares shorted versus average daily volume.
Right, the SRR, or days to cover. A high reading, especially after a market decline, can be seen as bullish fuel for a potential short covering rally.
Options data must be huge for sentiment too. Puts and calls.
Absolutely. The put-call volume ratio is a classic. High ratio means lots of put buying, bearish bets.
Which a contrarian reads as potentially bullish. Market getting too fearful.
Exactly. And a very low ratio suggests complacency, too much call buying, maybe a warning sign.
You can look at open interest ratios too for a longer-term view.
Yes, and even the premium paid for puts versus calls. Lots of variations.
What about mutual funds? Their cash levels.
Another contrarian favorite. When mutual funds are holding a lot of cash, they're cautious or bearish.
But that cash is potential buying power waiting on the sidelines.
That's the thinking. High cash levels are often seen near market bottoms, potentially fueling the next rally when they deploy it. Low cash suggests they're fully invested, maybe near a top.
And margin debt. People borrowing to buy stocks.
High margin debt signals high optimism, maybe even speculation. It also makes the market more vulnerable if prices fall, as margin calls could force selling.
And we can't forget the old odd lot theory, small investors being wrong.
Yeah, The theory that investors trading in small odd lots, less than 100 shares, tend to buy at tops and sell at bottoms. So you'd look at odd lot buying versus selling, or especially odd lot short selling.
Okay, let's talk momentum, the speed of price changes.
Right. How fast is the market moving? Is the trend accelerating or decelerating? Momentum indicators help with this.
Moving averages are fundamental here, right? Smoothing out price action.
Definitely. Simple moving average, SMA, is just the average price over, say, 50 days or 200 days. Helps see the underlying trend.
And exponential moving averages, EMAs, give more weight to recent prices.
Exactly. They react quicker to changes. Analysts watch for price crossing above or below moving averages, or for shorter-term averages crossing longer-term ones, like the golden cross or death cross.
Popular signals. What about MACD? Sounds complex.
Moving average convergence divergence, it's actually quite popular. It shows the relationship between two EMAs, usually the 12-day and 26-day.
And it plots this difference as the MACD line, and then an average of that line as a signal line.
Right. Crossovers between the Mackie line and the signal line are key buy-sell signals. You also look for divergence with price and for extreme readings suggesting overbought or oversold conditions.
Like RSI, Relative Strength Index. That's also about overbought, oversold.
Very much so. RSI is an oscillator that goes from 0 to 100. Readings above 70 are typically considered overbought and below 30 oversold.
But these levels aren't automatic sell or buy signals, are they?
No, definitely not. A market can stay overbought for a long time in a strong uptrend. You look for divergences again, price making a new high, but RSI failing to that's often a more potent signal.
Got it. And there are others like Williams's per SAR and stochastics.
Yeah, similar concepts. They measure where the current price is relative to its recent high-low range over a set period. Also oscillate between bounds to show overbought, oversold.
What about ATR? Average true range. Measures volatility.
Yes, ATR measures the average size of the daily trading ranges, factoring in gaps. It tells you how volatile the market is.
High volatility at bottoms, low at tops. Is that the tendency?
Often, yes. Panic selling at bottoms creates wide ranges, high ATR. Complacency near tops can lead to narrower ranges, low ATR.
Okay, almost there. Just a few other key tools and concepts. Bollinger Bands.
Bollinger Bands. Very useful. They are volatility bands plotted, usually 2 standard deviations above and below a simple moving average.
So they expand when volatility is high and contract when it's low.
Exactly. That contraction, the squeeze, often precedes a significant price move, though it doesn't tell you the direction.
And if the price touches or moves outside a band.
A move outside suggests the trend is strong, maybe continuing, but a top or bottom made outside the bands, followed by a move back inside, can sometimes signal a reversal. And prices often move from one band towards the other.
Interesting. What about Dow theory? That's like the grandfather of technical analysis.
Pretty much. Charles Dow's ideas from over a century ago. It talks about primary, secondary, and minor trends. Crucially, it emphasizes confirmation between different market averages, originally the industrials, and the rails, now transports.
So both averages need to be confirming the same trend direction.
That's a key tenet, yes. And volume should expand in the direction of the primary trend. Criticisms are that it's sometimes vague and its signals can be late.
Elliott wave theory. That sounds complex too. Waves and Fibonacci.
It is. R. Elliott proposed that markets move in predictable, repetitive wave patterns, 5 waves up in the direction of the main trend, 3 waves down, correcting it. These waves supposedly relate to Fibonacci number sequences.
But isn't counting the waves notoriously subjective?
That's the main caution, yes. Different analysts can look at the same chart and count the waves differently. But the underlying idea of market psychology moving in waves is influential.
And Fibonacci levels themselves are used, right? Retracements.
Yes, very commonly. After a move up or down, analysts will plot Fibonacci retracement levels like 38.2%, 50%, 61.8% to identify potential areas where a pullback might stop and find support or resistance.
What about insider trading, tracking what execs are doing?
Some technical analysts incorporate this. Significant buying by insiders in their own company's stock is often seen as a positive sign. Heavy selling is maybe less predictive, as insiders might sell for many reasons.
Intermarket analysis, looking at how different markets relate.
Crucial concept now. How do stocks, bonds, commodities, currencies influence each other? For example, the bond market often leads the stock market.
And the dollar's strength or weakness affects commodities and maybe stocks too.
Generally, a rising dollar can be bearish for U.S. multinational stocks and often for commodities priced in dollars like oil or gold. Relationships can shift, but they are important to watch.
Okay, just a couple more quick ones. Most active issues.
Just looking at the list of stocks with the highest trading volume each day can indicate where institutional money might be flowing.
Relative strength analysis, comparing a stock to the market.
Yeah, not RSI the oscillator, but comparing a stock's price performance or an industry's performance against a benchmark like the S&P 500. Is it outperforming or underperforming?
Seasonal momentum, time of year effects.
The tendency for markets to show strength or weakness during certain months or seasons, sell in May and go away, that kind of thing. Statistical tendencies,
Tyrone levels.
named after John Tyrone. They are horizontal support resistance lines based on the midpoint between recent highs and lows.
Tick indicator, very short term.
Yeah, it looks at the net number of stocks whose last trade was an uptick versus a downtick, often watched near the close for intraday sentiment.
And yield curve. That's more macro, but technical analysts use it.
Some do. The relationship between short-term and long-term bond yields. An inverted yield curve, short-term yields higher than long-term, has historically preceded recessions, which obviously impact stocks.
Wow. Okay, that was a very deep dive indeed. So to kind of wrap this up,
We've covered a huge amount. The essence is that technical analysis uses the market's own history, price, and volume through charts and indicators.
to identify patterns, gauge momentum, measure sentiment, and ultimately try to figure out probabilities for future price movements.
Exactly. And the key word there is probabilities. It's not about certainty or predicting the future with a crystal ball. It's about risk management and making informed decisions based on historical tendencies.
And definitely not relying on just one signal.
Right.
Combining tools.
Absolutely critical. Looking for confirmation from different types of indicators across different time frames gives you a much more robust picture.
Hopefully this gives you a much better foundation for understanding how technical analysts approach the markets and the kind of tools they use.
Yeah, it's a whole language, really.
It really is. Which leaves us with a final thought for you to mull over. Given all these recurring patterns, many tied to things like fear and greed, how much of technical analysis is simply reflecting predictable, almost inherent human behavior versus purely mathematical or random chart formations?
That's a great question. Where does market psychology end and pattern recognition begin? Something to think about.